Every trader has the same nightmare. It's not losing one trade, it's losing everything. The slow bleed, the false confidence, the final margin call. And it doesn't happen by chance. It happens by math. Because behind every blown-up account lies a brutal equation, one that doesn't care about your strategy, your emotions, or your dreams. Today, we're going to uncover the math behind blowing up a trading account and why so many traders walk straight into it without ever realizing it's happening. Let's start with a simple truth. Trading is arithmetic. The market rewards discipline and punishes compounding mistakes. When you lose 10%, you need an 11% gain to break even. Lose 20%, you need 25%. Lose 50%, you need 100%. And lose 90%, you need 900%. That's the trap. The deeper you fall, the harder it becomes to climb out. That's why account blowups rarely happen in a single day. They happen through slow mathematical decay, a death spiral hidden inside your risk management. Let's take an example. Say you start with $10,000. You risk 10% per trade. You lose 3 trades in a row. Your balance drops to $7,290. Now to recover, you need a 37% gain. You haven't done anything dramatic. You've just lost a few trades. But mathematically, your account is already broken. This is the compounding effect of loss. Every percentage you lose shrinks your base capital, so even if your win rate recovers, your growth rate never keeps up. Now imagine the psychological layer on top of that math. You've lost 3 trades. You're emotional. You want revenge. You double your size. You lose again. Now you're down 40%. To recover, you need 67%. Your emotions say, trade bigger. The math says, you're doomed. And this is where most traders implode. They don't blow up because of one bad trade. They blow up because they ignore the geometry of ruin. The geometry of ruin is the mathematical reality that once your losses cross a certain threshold, recovery becomes statistically impossible without changing your risk model. Let's break that down. If you risk 2% per trade, your odds of ruin are near zero, even with a 40% win rate. If you risk 5%, your odds of ruin explode exponentially. At 10%, you're one losing streak away from oblivion. Here's the formula. Ruin probability is almost equal to loss per trade divided by gain per trade plus loss per trade, caret number of trades. Most traders never calculate it. They trade emotionally, not mathematically. They treat their account like a slot machine, not a survival system. Professional traders know the secret. Survival is strategy. The math of success is boring. Small position sizes, controlled drawdowns, and consistent risk per trade. The math of destruction is exciting. Oversized trades, emotional scaling, and no exit plan. But here's the twist. Both paths use the same math. It's just how you apply it that determines whether you build wealth or destroy it. Let's take leverage, the most misunderstood amplifier in Forex. Leverage doesn't create risk. It magnifies it. If you use 100:1 leverage, a 1% move against you wipes 100% of your margin. That's not volatility. That's annihilation. Leverage gives small traders the illusion of control, but mathematically, it's a ticking bomb. The higher the leverage, the smaller your margin for error. A trader using 5:1 leverage can survive a losing streak. A trader using 100:1 won't survive a single mistake. And yet, people keep choosing the second option because they chase returns without understanding ratios. Here's the brutal truth. You can't out-trade the math. You can't feel your way out of probability. You can't manifest your way around drawdown curves. The numbers always win. That's why the most successful traders in the world talk about risk per trade more than profit per month. Because they know that the game isn't about making money. It's about staying in the game. Let's look at drawdowns mathematically. If you risk 1% per trade, even a losing streak of 10 trades only puts you down 10%. If you risk 5%, that same streak puts you down 40%. At 10%, you're out. Now here's where the psychology flips the knife. After losing 40%, your next 10% loss isn't 10% of your starting balance, it's 10% of what's left. The smaller the account gets, the harder it becomes to grow it back. That's why the percent gain illusion destroys traders. A 50% gain feels the same as a 50% loss, but it isn't. Because 50% down plus 50% up is not equal to break even. It equals minus 25%. That's the cruel math of asymmetry. Markets move symmetrically on charts, but not on capital. That's why every professional risk model focuses on maximum drawdown tolerance. It's not about how much you can make. It's about how much you can lose before you mathematically can't recover. And here's the part nobody tells you. If you lose 80% of your account, you need a 400% gain to get back to break even. Almost no one ever does that. That's why the math of destruction is irreversible. Once you cross that line, no strategy can save you. So how do you stop it before it starts? 3 principles. 1. Risk small. No single trade should threaten your account. Ever. 2. Respect compounding. It works both ways, for you when you win, against you when you lose. 3. Know your ruin threshold. Every trader has one. Find it, stay miles above it, and never cross it. Because trading isn't about predicting the future, it's about surviving long enough to profit from it. The traders who last aren't the smartest. They're the ones who understand math. Because the numbers don't lie. They just wait. If this helped you see trading differently, make sure to like, comment, share this video with your fellow traders, and subscribe for more deep dives into the hidden mechanics of risk, leverage, and survival in the markets.